I think in the U.S. we continue very much like we have post-crisis to bounce along the bottom. So if you think about it, we were running at 1.5%, occasionally 2% GDP growth over the last 5-6 years. That largely continues to be the case. I think coming into the year with the new administration, our view is we would have seen GDP growth pick up a little bit more than it has. I think what we're seeing is the fallout from the lack of the administration to get through all of the things the markets were looking for. So if we take a step back after the election, you had a big run up in equity, a big run up in perceptions around we're going to get tax reform, healthcare reform, we'll continue to get regulatory rollback and an infrastructure program. Here we are, roughly 200 days into the administration. We've only gotten partial one of them, and that is regulatory reform. I think we've made some pretty good progress there. That's had some positive effect on some of the numbers and some of the sentiment numbers we've been getting. And we've seen GDP pick up to roughly a 2% to maybe 2.5% level. I think healthcare reform is certainly stalled. I don't think we've seen the end of it. I do think we'll get something done perhaps later this year. If not next year, because we have to get something done. The system is broken, and it's going to force the issue at some point, down the road. A lot of the healthcare reform was needed to get the deficit in order to get tax reform done. I think the window for comprehensive tax reform is quickly closing. So I think at this juncture, our view is you'll get some type of modest tax reform, probably movement on the corporate side, and maybe some modest adjustments on the individual side. Infrastructure, which is also based off of how much money do you have to spend, is in the cards. And so I think they wanted to sequence these. It's not looking like that's going to happen. I do think you will get some infrastructure spending, because the one thing folks in Washington can agree on is they like to spend money. It's a matter of what priorities will take precedent. So I think you will get some infrastructure bills latter this year and into next. What does that all mean for the U.S. economy? I think it means more of what we've come from with a gradual and slow improvement. So if we were at 1.5% GDP growth, I think we have a path towards maybe 2.5% GDP growth. I think you still have a productivity problem. You still have a skills gap problem on the employment front. So while the unemployment rate continues to decline, and that's a positive, you're not seeing the wage growth because they're not in the right sectors. So I think what that backs into is no real risk of recession going forward. I think that's extremely low at this juncture, but I also don't think we get the big bounce in growth. So more of the same, which is kind of boring, but it's probably actually good for markets because it allows us to continue to have this expansion go uninterrupted.
All investments are subject to risk, including the possible loss of the money you invest. For more information about SkyBridge Capital Multi-Advisor Hedge Fund Portfolio Series G, call 1-888-759-2730 to obtain a prospectus. Investment objectives, risks, charges, expenses, and other important information about a fund are contained in the prospectus. Read and consider it carefully before investing. This webcast is for educational purposes only. We recommend that you consult a professional advisor about your individual situation.